Ask yourself a question that might instantly snap you out of this market frenzy. Are the numbers in your account, that tech stock you just hit a new high on, truly your wealth, or just a mirage that could vanish at any moment? I know, watching your account grow daily is an addictive dopamine rush. You might think, this time is different. This is the AI revolution. This is a leap in productivity. But is the price of the stock in your hand truly supported by the company's cash flow over the next decade? Or has the market's logic quietly evolved into a game of musical chairs? Let's shift our gaze from the noisy stock prices to the deeper currents. This week, something extremely strange happened in the market. Did you notice? Bank of America, Wall Street's previously hawkish giant, the one always preaching higher for longer, suddenly changed its tune. This isn't a rumor, it's a massive signal. In finance, this is called the canary in the coal mine. When an institution of this caliber suddenly reverses course, predicting the Fed will cut rates earlier and more aggressively, there must be something that's made them feel the chill. Their reversal isn't because Powell suddenly became benevolent or because they pity your monthly mortgage payments. The reason is singular. They've seen cracks in the so-called strong economic data. Let's look at some figures. While non-farm payroll data appears to be growing, it's a window-dressed number, revised and polished. If you dig into the real hiring situation in the private sector, look at the hiring intentions of small and medium-sized enterprises, you'll find it's softening rapidly, like melting ice cream. And credit card delinquency rates are climbing to decade highs. What does this mean? It means the engine of the U.S. economy, the consumer, is exhausting their last savings. Bank of America sees this. They realize that if the Fed doesn't act, that dreaded word, recession, is truly coming. The market's pricing is already extremely aggressive. Data from the Chicago Mercantile Exchange shows bets on near-term rate cuts have surged. What does this mean? It means Wall Street has collectively placed its chips on the table, forcing the Fed's hand. The current situation is, the Fed is cornered. The market is saying, Powell, if you don't cut rates now, if you don't press that money printing button, we'll crash. If you remain oblivious, waiting for next week's Fed press conference and reacting only after seeing the headlines, you'll once again be a victim of information asymmetry. Wall Street is already positioning, buying bonds, locking in profits, preparing for the coming storm. As retail investors, we must squeeze into that safe room before they close the door. I know when bonds are mentioned, many immediately think, that's for retirees, that's junk. With only 4% dead returns, I want Nvidia's 40%. This bias is exactly what Wall Street wants you to maintain. Because only if you disdain bonds will you keep your money in the stock market for them to dump on. But let me tell you the real logic now. Stocks are about stories, dreams, and price-to-dream ratios. Bonds are about math, law, and contracts. In this uncertain world, bonds offer an extremely scarce resource: certainty. When you buy a U.S. Treasury bond, you're not gambling. You're entering into a legally binding loan contract with the most powerful economy on Earth, the U.S. government. As long as the U.S. government doesn't default defined as risk-free in finance, your principal and interest are obligations that must be paid, not gifts like dividends that can be cut by a company's board at any time. Why is this the golden window? Because bond yields move inversely. When interest rates are high, bond prices are low, but the future cash flow you lock in is extremely high. Currently, 1-year or 2-year Treasury yields might still hover around 4.2%. This is one of the highest risk-free returns we've seen in the past 15 years, but this window is closing rapidly. Once the Fed announces a rate cut, or even just hints at one, new bond issuance rates will drop accordingly. It's like the final hour of a supermarket clearance sale. These yields above 4% are the last gift from God. You must lock in today's high future cash flow before Powell strikes the gavel, before the latecomers flood in. Imagine if the economy truly enters a recession next year and the stock market crashes 30%. while you hold part of your portfolio in bonds locked at 4% returns, or even long bonds that have surged in price. That sense of stability, that composure of "I didn't lose this round," is the mark of a mature investor. All right, if you understand the logic, what should you do specifically? Should you just open your account and buy randomly? Absolutely not. The bond market is deeper than the stock market. Buying the wrong thing will still make you lose money. Let's start with the most stable and fundamental: physical treasury bonds. That is to say, treasury bills, T-bills, or notes. If you have money that absolutely cannot be lost, like your down payment for a house next year, your child's tuition for next semester, or your retirement nest egg, listen to me. Forget stocks. Forget those complex bond funds and honestly buy physical treasury bonds. In the US, you don't need special channels. You can go directly to the US Treasury's official website, Treasury Direct, though the interface looks like it's from the last century, it's the most direct. Or more simply, through your regular brokerage accounts like Fidelity, Charles Schwab, or Interactive Brokers. In the fixed income section of these platforms, you can buy treasury bonds just like stocks. Why buy physical? 2 words: lock-in. When you buy a 1-year treasury bond with a 4.2% yield and decide to hold it to maturity, any market fluctuations in between are irrelevant to you. Whether the Fed cuts or hikes rates next week, whether Powell cries or laughs, whether inflation rises or falls, it won't affect your principal and that 4.2% interest at maturity. This is immunity. You've locked in today's interest rate, excluding future uncertainties. On the eve of a rate cut cycle, this locking ability is priceless. Because once rate cuts begin, your 4.2% contract becomes a scarce asset, while others might only be able to buy bonds at 3.5% or even lower yields. If you find buying physical bonds too cumbersome, want better liquidity, or seek higher returns, then bond ETFs are your choice. But here lies a huge trap, the place where most novices lose money. You must distinguish. Short-term bond ETFs and long-term bond ETFs are completely different species. First, cash alternatives. Short-term bond ETFs, SGOV, SHV. These ETFs hold extremely short-term treasury bonds, 0 to 3 months. Remember, these are your super cash. Where are your idle funds now? If they're still sitting in a regular checking savings account at Chase or Bank of America, earning 0.01% interest, you're literally committing a crime. You're giving your wealth away to the banks. Banks use your money to buy treasuries at 4.5% and then give you crumbs. Stop being a sucker. Move these idle funds into SGOV or SHV. These ETFs have minimal volatility. Their charts are almost a straight upward sloping line. They pay dividends monthly, with annualized yields currently closely tracking the federal funds rate. Even if rates drop from 4.5% to 4% in the future, so what? It's still the safest haven in the high valuation U.S. stock market and your ammunition depot. When the stock market corrects, these are the bullets you can deploy at any time. This is your shield against inflation. Next, we enter the high-risk, high-reward zone, long-term bond ETFs, like the famous 20-plus year Treasury Bond ETF, TLT. Many watch TLT, thinking it's the secret to getting rich in a rate cut cycle. The logic is, bond prices and interest rates move inversely, and the longer the duration, the higher the sensitivity. If the Fed cuts rates aggressively, TLT could indeed surge in price due to duration effects, even outperforming stocks. This is called capital appreciation. But there's a huge red flag here. Long-term bond ETFs are a double-edged sword. TLT has a duration of about 16 to 17 years. This means if long-term interest rates rise by 1%, TLT's price will drop by about 16-17%. This volatility is comparable to tech stocks. Why would long-term interest rates rise? Even if the Fed cuts rates, long-term rates could still rise. This is called a steepening yield curve. If inflation resurrects like a zombie, or if the market fears excessive U.S. government borrowing and shirking fiscal deficits, Long-term rates will spike and TLT will become a widowmaker, making you lose your shirt. So, never treat TLT as a capital preservation product. It's a counter-hedge tool in your portfolio. You allocate to it because you believe the economic recession might be more severe than expected, because you think the stock market will crash, and funds will flock to long-term bonds for safety. If you don't have such an extreme macroeconomic judgment, please approach TLT with caution or strictly control your position. Having said all this, how do we build a solid fortress with these building blocks? I don't recommend extreme all-in or all-out strategies. That's gambling. Mature investors use the barbell strategy. It means abandoning the mediocre middle ground and, at this extreme moment, seizing the certainty at both ends. On one end of the barbell, you should heavily allocate 60%, -80% of your funds to short-term bonds, physical T-bills, or SGOV. This is your ballast, ensuring your principal is safe and generating decent interest income regardless of what happens. This money lets you sleep soundly during stock market crashes and gives you funds to buy the dip when opportunities arise. On the other end of the barbell, you can lightly allocate 10%, -20% of your funds to long-term bonds, like IEF, or a small amount of TLT as insurance. If the economy crashes hard, this part will surge to hedge risks. Keep the remaining funds in your core high-quality stocks. I'm not telling you to liquidate your stocks. In the early stages of rate cuts, liquidity flooding might push tech stocks higher. But deleverage. The current risk-reward ratio no longer supports borrowing to trade stocks. Also, remember a psychological tactic. Buy the rumor, sell the fact. The current surge in rate cut probabilities means the rate cut itself has already been priced into the market. So, if the Fed truly announces a rate cut next week, you might see bond prices not rise but fall, or stagnate, or even turn into bad news after good news. Don't panic, this is normal. Our current allocation isn't for the short-term fluctuations of the next week or two. That's for day traders. We're playing a longer-term game. Our current allocation is to buy insurance against macroeconomic changes for the entire coming year to survive the potential economic slowdown in 2026. The current market is like a bar full of drunkards. The music's still playing, everyone shouting, "One more round," all believing the party will never end. What I want to do is be the one in the corner handing you a glass of ice water and patting your shoulder to remind you, "Brother, the party might be ending soon, it's starting to rain outside, time to call a ride home." This doesn't mean the end of the world, nor does it mean you should sell everything and hide in a bunker. It just means you need to be more vigilant, more professional. Check your cash, don't let it sit idle, examine your leverage, don't expose yourself to huge risks. In this market, only those who survive have the right to talk about long-term compounding. Don't be the one picking up shells on the beach when the tsunami is coming. Put on your life jacket, bonds. Fasten your seatbelt, deleverage. And let's see what tricks Powell and that unpredictable market can pull next week. Stay liquid, stay hedged, and stay smart. See you next time.